let's bring in then Ben Harburg, managing partner at MSA Capital. It's a global investment firm which manages $2 billion in assets, including significant holdings in China. They've invested in the likes of Uber as well, Airbnb, and in China, the likes of Meituan as well, and Neo. Ben, good morning. Thanks for coming to the studio. Really great to have you. Spend a lot of time, of course, on the ground in China. As we look at the changes, and you're seeing approvals for gamings, for example, and you're seeing the approval of the capital raise for Ant of around $1.5 billion, how significant are these changes? Is this a material pivot now in terms of China's crackdown on technology? How convinced are you and your LPs that this marks a pivot?
Well, there's a difference between me and global investors, but certainly for those of us on the ground, this is a massive shift and one that was anticipated. We saw this coming on the basis that once we had the Central Party Congress in October, that would provide kind of political stability. Then we had the Central Party Work Conference that laid the groundwork for the type of growth that they'd be stimulating this year, a much fresher and positive attitude towards entrepreneurs, towards the technology platform companies like Ant and its parent Alibaba, Tencent, and obviously a lifting in a lot of the regulatory sanctions that were imposed on technology businesses.
Ben, you're confident with that call, because it seems that with the sudden reopening and I guess abandonment quite aggressively of COVID-0, there's a lot of questions on what the focus on. Yes, life sciences, technologies is still a question mark of what they plan to do longer term.
Yeah, certainly I think there's a focus on life sciences and core technology, particularly as we have to wean ourselves off dependence on the United States. We're seeing a first-in-class emergence of newly innovative technologies in life sciences space, the likes of which we'd never seen before in China. But I do think this is a very authentic effort from the Chinese government and will continue throughout the course of the year. It has to. Last year was just simply devastating on the economy.
So it's authentic. And our LPs, because you had a nod to this in your answer then, that there's maybe a different, in terms of your view and the view of LPs, are you struggling to convince LPs, your US-based LPs, that they should now get exposure, or they should continue, or they should increase their exposure to China?
There are different classes of limited partners around the world. So there are those in underexposed markets to China, like those in the Middle East. They are very convinced of the opportunity there. I think people in Europe and other relatively underexposed markets are now warming up to the idea, and I do think that China is probably a better bet today from today's levels relative to the U.S. To see improvement over the course of 2023. Other markets like the United States might be to some degree over-allocated to China, and also there are some political and moral concerns there that might outweigh some of the financial considerations around recovery, and so there's a bit more pushback from some of those limited partners.
So, Ben, concretely, where do you want to invest? And actually, are you seeing really the U.S. and China getting closer, or is that going to be a very volatile relationship this year?
2023 definitively will continue to accelerate that decoupling. I expect that potentially in the next couple months, if not weeks, we'll see some form of a capital ban from the United States towards China. We've already seen actions taken in the chip space. Definitively, the United States is working to quell the rise of China as an economic and political counterweight, and I think that will accelerate in this year.
Okay, you're pretty definitive on that then. So how do you, if you do want that exposure to China, how do you shelter yourself from that volatility and those adjustments that you expect?
Well, the key thing first is to listen closely to the ground and put yourself within the regulatory slipstream of the Chinese regulators. And that's these sectors like core technology and life sciences, which definitively need to grow. Some of the bigger technology platforms, particularly on the consumer side, continue to see some of the regulatory interventions we saw. I don't think we're out of the woods yet there. So clearly you need to be where the government sees growth needing to come from and the critical needs sectors. And for us, those are those spaces in energy, new energy, efficiency drivers on the enterprise side, of course, core technology, and then this first-in-class emergence in the life sciences space.
Yeah, how difficult is it, Ben, to go in? I mean, you definitely need some, I guess, partner locally to make sure that you're protected somehow, or how do you do the investments?
We obviously have a large team on the ground. We have about 40 people on the ground in China, and this is a country that has definitively, you have to be there on the ground presence. If you are operating from other markets, it's extremely challenging. The last 3 years saw this massive arbitrage between what Western investors understood about the market and the realities on the ground, because very few China watchers, be they political or economic, were actually on the ground physically in China, and that just accelerated a lot of these false narratives around the market that I think misled global investors.
Just broadly, Ben, and you spend a lot of time with Chinese entrepreneurs. What has this done to China's entrepreneurial capacity, entrepreneurial drive?
2022 was a very challenging year. It was just one hit after another, a perfect storm of factors, and we saw a mass exodus actually of affluent and entrepreneurs leaving for markets like Southeast Asia, coming here to London and elsewhere. It was challenging, but I think if you look at the market outlook today relative to other markets, there does seem to be more opportunity for growth. We have a lot more bullets we can fire to stimulate growth. We have a lot more deltas where we lag the West in terms of healthcare, core technology, and also we have a lot of human-enabled actions that can take place to stimulate growth. So rolling back zero COVID, now this lightening of the risk of delisting of Chinese companies on Western markets, and of course now this regulatory intervention. So all of that provides a really robust environment for entrepreneurs to again work and grow.
All right, Ben, thank you so much for coming on. Ben Harburg, their managing partner at MSA Capital.